Welcome back to Curious Commerce. Cash flow statement, part second. In this session, we will discuss about the meaning, definition, and objectives of cash flow statement. Profit tells how much you earned, but cash flow statement tells whether you can survive. Today, let's clearly understand the meaning of cash flow statement. Cash flow statement is a financial statement, just like profit and loss account and balance sheet. Cash flow statement is also an official part of financial accounts, but its special purpose is different. What does it show? Majorly, it shows two things very clearly: inflow of cash, where money come from, and outflow of cash, where money goes. So instead of asking, did the business make profit? It asks, did the business actually receive and spend cash? That is practical finance. Cash flow statement is prepared for a specific period. For example, cash flow statement for the specific month or for the specific quarter or for the specific financial year, just like profit and loss account. It compares opening cash and closing cash of the period. It is prepared on cash basis. This is the key point. Cash flow statement is prepared on cash basis, not accrual basis. What does it mean? If cash is received, we will record it. If cash is not received, it is not recorded in the books of accounts or in the cash flow statement. If the cash is paid, recorded. If the cash is not paid, it is not recorded, it is not mentioned. For example, you sold goods worth around 20,000 rupees on credit. In books of accounts, recorded as profit, but not shown in cash flow. You received 10,000 rupees from debtor, shown in cash flow, even though sale happened earlier. Cash flow statement ignores promises. It records only the reality. Dear learners, you can write it down. A cash flow statement is a financial statement that shows inflow and outflow of cash and cash equivalents during a specific period prepared on cash basis. This is the perfect answer. So remember, it is a financial statement. It shows cash inflow and outflow. It is prepared for a specific period. It follows cash basis. If you understand this, your foundation of cash flow is strong. Sometimes one sentence can explain an entire financial concept. Now, we will deeply understand the simple but powerful definition of cash flow statement. A cash flow statement shows the inflow and outflow of cash and cash equivalents during a particular period. Let's break the sentence into three parts. It includes inflow, outflow, and a particular period. Inflow means we already know cash coming into the business. Cash outflow means cash going out of the business. Particular period means for the particular month or for the particular quarter or for the particular financial year. It helps us answer how much cash increased or decreased during this period. Not lifetime, not guesswork, only for this specific period. Because this one statement explains it is about real cash, not profit. It focuses on movement of money. It shows business liquidity. It helps in survival decisions. Profit shows success. Cash flow shows the survival. So now you clearly understand and note it down. A cash flow statement shows inflow and outflow of cash and cash equivalents during a particular period. And with this, your foundation and cash flow is strong. Why do companies like startups fail? Why do profitable businesses still struggle? Because they do not understand one thing clearly, that is cash flow. Now we will understand the objective of cash flow statement, not just for exam, but for real business life. If you master these objectives, you are thinking like a financial manager. Cash flow statement is not prepared just for formality. It has clear purposes. There are four major objectives we must understand to know cash generated from operations, to understand investing and financing activities, to assess liquidity position of the firm, to help in planning cash requirements. Let's understand each one with simple logic. To know cash generated from operations, this is the most important objective. Every business runs mainly on its daily operations, like selling goods, providing services, collecting from customers, and paying expenses. The question is the core business generating enough cash? For example, a company shows profit of rupees 5 lakh, but cash from operations rupees 50,000 only. That is a dangerous signal. Why? Because profit may be due to credit sales, or from accounting adjustments or from non-cash incomes. But salary, rent, EMI requires real cash, right? A healthy businesses must generate positive cash from operation activities. Operating cash flow shows the true strength of business. The second objective of cash flow statement is to understand investing and financing activity. Cash flow statement also helps us to understand where the company is investing money and how the company is raising money. The investment activities include buying land, buying building, buying machineries, or sell off the assets, investments in shares or any other financial instruments. If company is regularly investing in good assets, leads to a growth mindset. For example, a company buys new machine worth rupees 10 lakh. Cash goes out today, right? But future production increases. This is not loss. This is smart investment. Second part of the second objective is the financing activity. Financing activity include issue of shares, taking loan from the banks, repayment of loan, dividend repayments. This tells us how company is managing its capital, whether it depends heavily on loans, whether it is financially stable or not. For example, if company keeps borrowing every year, leads to risk increases. If company repay loans regularly, leads to financial strength improves. So, cash flow statement gives a complete financial picture of the organization. The third objective of cash flow statement is to assess liquidity position. Liquidity means ability to pay short-term obligations on time. Can the company pay salary, rent, electricity, creditors, bank EMI? If cash balance is weak, leads to even good business will suffer. For example, profit-making company but unable to pay rupees 50,000 salary on time leads to reputation damaged. Employees think that it is not safety place, that's why they leave the organization. The end result is business collapse. So through the cash flow statement, we check is cash increasing or decreasing? Is the business financially comfortable or not? Can it handle emergencies? This is called liquidity assessment. The fourth objective of the cash flow statement is to help in planning cash requirements. This objective is very practical. Cash flow statement helps management answer for the following questions. How much cash will we need next month or for the specific period or for the specific quarter? Can we buy a new machine now or not? Can we afford to hire a new staff or not? Should we take loan or wait for some more time? For example, if cash flow shows low inflow expected, low cash inflow expected next 3 months, then the management will avoid big expenses, delay expansion, and control costs. But if cash inflow is strong, automatically the management think that expansion possible, investment possible, and growth planning possible. So, cash flow statement becomes a planning tool, not just a report. So, remember the four major objectives clearly: to know real cash from operations, to understand investing and financing decisions, to check the liquidity positions, to plan future cash needs. Profit is for books, cash flow is for survival, planning is for success. Thank you for watching. Follow our WhatsApp channel Curious Commerce Financial Management Hub for daily finance learning. Please like, share, and subscribe. The topic cash flow management will be continued in part 3.